Hello, I'm Raul Elizalde with a quick take on the markets. All the talk about reducing the US deficit and putting the fiscal house in order, so to speak, is encouraging. The sooner the US confronts its growing fiscal imbalances, the better. But we would all benefit if policymakers remember that fiscal health is not just a matter of taxes and spending. What does that mean? Well, it means that smaller fiscal deficits or even fiscal surpluses are not an indication of the long-term health of a nation. In the United States, we were running fiscal surpluses in 2000, and 10 years later we're confronting a fiscal problem that was hard to imagine back then. Okay, 10 years is a long time, but what about Europe? Ireland ran 10 years of fiscal surpluses before 2008, only to face a staggering 32% budget deficit this year. Clearly something else is going on, but what? Well, the answer is that when looking at fiscal health, government accounts are not sufficient. Looking only at the deficit or surplus or indebtedness of the federal government and ignoring what is going on in the private sector is a recipe for trouble. That is what was brewing in the United States in the years prior to 2008. Federal debt was pretty much contained at around 40% of GDP, so you would not have seen any trouble there. But if you had looked at the size of the debt of commercial banks, you would have been alarmed. It grew from 20% to 120% of GDP by 2008. Since then, it went down to 100% of GDP. Where did that 20% go? To the federal government through bailouts. So it was not spending that got us in our current troubles, but the nationalization of private debt. This is usually what happens in financial crisis, that is, when the banking system gets in trouble. Banks are very important for the functioning of any economy, so in a crisis, they are typically bailed out, especially the large or systemic banks. Since they cannot be let go under, their debts end up being owned by the taxpayer, and they inflate the size of the federal debt and the federal budget deficit. Now, if that is the case, then you should really be alarmed by what is going on in Europe. Banks have grown much bigger in Europe than in the United States. While in the United States, commercial bank assets are about 100% of GDP, in Europe they are much larger. Belgium, Portugal, Spain banks, for instance, are 3 times that size. In the UK, banks are 5 times GDP. Ireland is in so much trouble because its banks have assets that are 10 times GDP. And since they need to be bailed out to prevent a full-blown banking crisis, the fiscal costs are tremendous. The question is whether the austerity measures that are now so popular in Europe are the right medicine. One could easily imagine a situation where austerity leads to lower growth, and that could put further pressure on European banks if lower growth translates into a larger proportion of their assets going into default. Then the fiscal problem will be larger, not smaller, because although you save here and there, the costs of nationalizing the banking system debt could be just overwhelming because it is just too large. The United States is finally starting to show signs of growth. Political discourse may be getting a bit better, employment may be starting to improve, and the financial system may be healing up. All that is positive for US equity markets, but the potential for an external shock from Europe has not diminished. Instead, it seems larger now than earlier this year when Greece first got into trouble. Investors are justified to add to their equity positions, but they should do so keeping in mind that there is a potential for shock, and they should be adjusting their exit strategies accordingly. For more information, please visit us at www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.